So think of the V1 as very much a proof of concept, right? We get it online, printing the index. Index has been printing now for almost 11 months. I think on average of like, 5 times per asset per day. So with the V2, we're really looking at making, much more interesting, much more useful.
No vídeo de hoje eu conversei com o Darren Camas, ele é CEO e cofundador do IPOR Protocol. É um protocolo de DeFi com muito potencial e aqui ele mostra toda a visão dele para o crescimento de derivativos de swap, junto com stablecoins, também liquid staking e no futuro também real world assets, os ativos digitais do mundo real. Hello everyone, I have here again with me Darren Camas. He's the co-founder and CEO of the IPOR Protocol. IPOR, it's an interest rate swap protocol from DeFi, and we had already Darren here in February. We recorded in January of this year, so if you still didn't see this, I'm gonna let the link here so you can click and know the history of IPOR and all the beginning. Today we're gonna talk about what happened to IPOR and what about the future. So thank you for coming again, Darren.
Thanks, Marcelo, for having me. It's nice to be back.
Good. And I also would like to thank Luciano Colombo because he made the bridge between us. So if you still don't know Luciano Colombo, follow him in his Twitter, Instagram, and YouTube channel as well. So to start with, IPOR was a protocol that was launched, the mainnet was launched last year. And so we talked in January. And what can you talk about us, Darren, now? What are the achievements that you have been, what have you been proud of IPOR in the last months?
Okay, great. So yeah, the protocol was launched on mainnet August 16th in 2022. Since then, and when we spoke, it was right around the launch of liquidity mining.
Yeah.
So those are some pretty important benchmarks. So if we talk about, kind of product launch, liquidity mining launch, and then another one of those is about 3 months after the mainnet launch or the liquidity mining launch, we had a liquidity mining revision. So if we go through highlights, this really started to build, a bit organically. And then with the liquidity mining, it brought a lot of eyes and attention to the protocol. So that actually allowed the protocol to scale from about 2.5 million in TVL up to the peak of about 43 million. And this was, I believe, sometime in in February. And so since then, I think protocol liquidity has stabilized right around 18 million, and that's where we stand today. So I can take you through kind of this journey, all the way through. And so if you remember last time, we talked about a little bit about the power token dynamic, which is the novel liquidity mining mechanism of IPOR. We also talked about the swap mechanisms. And then, you mentioned the future, maybe a little later we can talk about the V2. And the V2 does a lot of things like building on the V1 architecture, expanding the utility of the swaps, actually launching new instruments. And maybe we can get into that just a bit later. But those were really some of our highlights. So if we talk about numbers, we peaked at 43 million TVL. We had this, I think, a very high speculative wave at the very beginning. We had what's pretty typical for a liquidity mining price discovery, token bleed out, find your equilibrium, and then grow from there. And so we had some very, very interesting times, I guess, in Q1. So if you want to read more about the Q1, it was very kind of crazy times in the markets in general, also in the interest rate markets. So there were a couple of very fascinating and also very scary kind of examples. So one was we had a whale that was looking to basically hunt the IPOR swaps. So they would take large positions and then flush up the money market rates on Aave and Compound to try to get their longs paid. In the end, we were able to close those actually with very little damage to the pool. There was a second time where the whale tried the same attack, and actually they were unprofitable. So the pool actually made money out of that. But these were very good lessons, to building out the V2 instrument. So basically, you had one party that was taking multiple swaps. They were opening them on one leg, they were closing them, and then opening the other side, and then raising up the borrowing. Basically, borrowing. You're raising up the utilization and raising up the interest rate mechanism on Aave, which affects the IPOR index. And then they had this kind of interesting looping mechanism. So then they would borrow from Compound, deposit that into Aave, which would increase the weight of Aave in the index, and then borrow against that to kind of keep this kind of looping attack. And so that was fascinating, scary. Again, the pool, I think in total lost less than 0.5% of the deposits just from the USDT pool only in the first attack, and in the second they actually the attacker lost money. So how we dealt with that was we started very aggressively capping the leverage and the notional that the pool could underwrite. It doesn't make sense, for example, when there's, let's say 200-300 million in notional outstanding to allow, 2-3 billion. It's just not really needed. And so we have a mechanism that we designed for the V2, which is this risk oracle. And this risk oracle really monitors what's happening in the credit markets. And it's looking for like situations like this, like there's this interest rate kink, right? So, if you take, up to about 80% utilization, it's pretty flat, but then it starts to spike, right? So if you think like they're just in this utilization, let's say the pool's at 75% or 70%, and there's 50 million between the 70% and the 80%, we know that this is cost to kink, right? So it's about $50 million that it would take to flush up the markets. So we're looking at that as kind of a risk threshold that the pool can underwrite. And after that, it starts aggressively capping the notional exposure and the leverage. So the basic, the basic function of that is in the case that someone wants to flush up the rates, that this attack would be unprofitable. It would be a break even. And so we have a couple of different circumstances. So this whale is also an IPOR LP, and they're also an IPOR trader. So first, they did these two kind of attacks against the protocol. Then they played a very interesting one. So the LP, the liquidity pool, lost around a third of the TVL. Nothing related to IPOR, but this was in the Silicon Valley bank crisis, right?
Oh, yeah.
And so that was when everyone was worried that USDC was going down. And, internally at IPOR Labs, we thought this was overblown. We were looking at kind of the risk dynamics. And we'd internally marked, let's say USDC, 97 cents to the dollar. And so what this whale did in that case was they actually withdrew a lot of their pool positions, not only from IPOR protocol, but from many other protocols. They borrowed USDT max. And so this actually flushed the USDT rates up across all of DeFi. USDT was trading about 6% premium to the dollar because people were trying to leave USDC. And they actually used that USDT at a premium to buy USDC at a discount. So they weren't really worried about facing something like 120% borrowing cost on their USDT positions because they were really playing the 14% arbitrage of the DPEG repeg event on the USDC markets. And they did very well from this. And it was a very kind of contrarian approach to that particular market event. So this is obviously a very sophisticated actor. And so actually, maybe just 1 month ago, there was a USDT kind of FUD, very quick DPEG. So the same actor, what they did was they started maxing out USDC to buy USDT. So the opposite, right? But the really nice thing was they actually took out the IPOR swaps to hedge their borrowing cost on the money markets. So what turned from attacker actually, and also let's say a friend, because they're also a liquidity provider, they turned into a protocol user. So it's really fascinating to see these kind of online Ethereum wallets their behavior turn to actually using the protocol to hedge their money market exposure. So that, I think, was one of the really kind of cool, kind of crazy, but very interesting events that happened. And that really highlights, one, testing the risk engine, two, how the IPOR protocol is useful in these kind of depeg and repeg scenarios, and that they found it very actually useful to hedge their cost of borrowing.
Wow, very, very interesting recap. So, as you said, since our last conversation in January, so there was the liquidity mining program that will attract a lot of TVL. Protocol grew. So also there were challenges like a whale trying to manipulate Aave and Compound. It was both Aave and he was trying to manipulate Aave and Compound.
They flushed the rates up on Aave first, and then they used Compound to kind of effectuate this looping attack.
Yeah.
So it was fairly fascinating from the social engineering perspective.
Yeah.
And our team really looked at that and looked at, how can we reverse that and how can we use that to build limits in our risk engine for the V2. So it was actually a very strong learning experience.
Yeah, very, very interesting. And also you mentioned Silicon Valley Bank and the problem with the banking crisis in the US in March. This was for me my biggest, I'm not gonna say concern, but not with IPOR, but I mean in that time I was worried about the whole DeFi market because DeFi is a lot of based in stable coins. So and I remember because I was using the IPOR protocol since November of last year. And I remember, at least at my perspective, it was not very difficult to predict the behavior of the interest rate from especially the USDT, USDC sometimes. I was trying to speculate a little bit there. And I think there was a kind of, I don't know, for me, it was a predictable behavior. But after the banking crisis, for me, it was like, oh my gosh, I don't know what's happening right now, because I think things were a little bit difficult. And talking about this stablecoin crisis that happened with the USDC that lost peg and then USDT right now, what do you think about the future of the stablecoins in general? Because do you have a vision for what's going to be the ultimate solution? Centralized like USDC, USDT, CBDCs, or maybe some decentralized stable coins. Now there are coming a lot of decentralized stable coins with liquidity staking. What's your take, your vision about this market?
Yeah, I think it really depends on like which act you're talking about, right? The largest by far are the centralized, centralized issuer stable coins. So we're talking about, USDC, USDT. And actually, with the issue with the banking partners in the US, USDT got stronger while USDC actually fell a bit out of favor, where formerly it was known as, let's say, the safe bet, the regulated bet. It has, it had the kind of in-kind approval by the former Office of the Currency Comptroller. And it was seen as, let's say, the institutional play. But I mean, the biggest issue is that it actually relied on the traditional banking system. Crypto really had this existential pressure put on it, not by anything else, but these banks' bond market exposure, right? The bond market exposure by Silicon Valley Bank, by Silvergate Bank, and a number of other banks was long bonds, which essentially what's considered a very safe instrument, and their value dropped because of essentially the rate hiking, right? So this goes back to monetary policy. This goes back to the traditional banking world, and so that's a bit crazy. So in my mind, it shows a need for algorithmic stablecoins. So that would be, on my ideological side. But on the other side, it's all about convertibility, right? So people that want in and out, and if we want to actually bridge these funds from traditional finance, they're probably going to flow over these centralized rails, right? So I think that that will continue to be a very strong factor. And what my hope is actually these centralized stablecoins win out in the long run over CBDCs.
Yeah.
And I mean, we see a lot of people pushing the CBDC narrative, but we don't really see the distribution, right? The question is, maybe suddenly it will be pushed, but we've seen it pushed out in China, which is the only place that can do it at scale because it has such strong native digital banking infrastructure. So stablecoins, I also expect to see a lot more euro-backed stablecoins, but I don't think that they'll grow, at the rate that the USD stablecoins will. And I'd like to see that actually bring on, different cases. For example, for Forex on-chain. Forex on-chain also gives birth to cross-currency interest rate swaps. And so that's, that actually really strengthens the IPOR narrative. And what you mentioned about this, that rate behavior is, this is why we have an index for USDC, USDT, and DAI, because they effectively have different rate characteristics. And so our head of BD, institutional BD, Costas, he wrote an article about how you can play, these different kind of rate scenarios, these divergence or convergence trades, where you think that the rates are going to go, let's say that, USDT rate is going to spike and USDC rate is going to drop. And actually, this will be one of the features of the V3, where you can just select, a very simple rate strategy, one click, and play it out over time.
V3 or V2?
Sorry, V2.
V2. Oh, I thought there was a V3 already.
Not a V2.
All right. And so are there any stable coins protocol with liquidity stakings that you're looking at, or that you see any potential in these protocols?
Yeah, you're talking about the staking rate or what?
Well, I mean, there are products that like Libra. There's one stable coins that they are using the liquidity staking from Lido, and also they're going to add other liquidity staking protocols to use as collateral. Possibly they're going to use the yields from the staking also to compensate liquidity providers or the issuers, something like this.
Yeah, so there's a number of different stable coins that we've been in discussions with, some that are issued by some very well-known, DeFi protocols. But, the decision for those will ultimately be by decentralized governance, right? And so we just actually brought on a team member that actually came to us through the DAO, whose responsibility is going to, designing the parameters of, when do you spin up an IPOR index for a new protocol? What are the liquidity considerations? How many money markets must it be available on? Things like this. But those are all possibilities, right? So this market is very quickly expanding, and the options are out there. The other thing on the staking side is actually the biggest thing that we're focusing on is the ETH staking, right? So, kind of at our core are the money markets, which are credit markets, right? But if we think in traditional finance, your credit market rates are directly correlated to what's effectively monetary policy, right? And in the same way, this kind of ETH staking rate will have a very strong indicator on what's going to happen, not only in, let's say, the IPOR ETH money market rates, but it will also affect what happens in the other rates, in the stablecoin rates. So one of the biggest things that we're focusing on is actually the birth of this new instrument, which is the stake rate swap. So think of it as an adapted swap to instrument where you can essentially, pay fixed or receive fixed versus the stake rate. So the first instrument, we don't have enough data to really construct a very good index because we just don't have enough history with the staking rates. Also, each of these like liquid staking protocols has its own, methodology and levels of centralization or decentralization when putting the rate on chain. So we'll launch a stake rate swap specifically for the Lido rates.
Okay.
So that will be the first one.
All right. And so there is any, this is going to be for V2. Do you have an estimate when when are you going to? What can you say right now for us to us?
I can say that V2 right now, it's with the auditors. And one of the big things that we're pushing in is to make sure that the stake rate swap goes in with the V3. So it really depends on the audit time. It really depends on, fixing anything that may come through the audits, and specifically making sure that this stake rate swap gets delivered to the market. So that could be anywhere. My guess is a couple months from now.
Couple months, but probably this year. Still this
definitely
year.
This year, for sure this year.
Yeah, very interesting. So the idea is to have the same way that there is this AMM swaps between interest rate from stable coins and fixed borrowing, variable borrowing from Aave and Compound. Now the idea is to have the same with liquidity staking from Lido, right?
That's correct. That's correct.
You're going to be able to swap between fixed and interest rate from Lido Finance, right?
That's correct.
Oh yeah, very good. Yeah, because this market's growing a lot. Like I was thinking, the liquidity staking market today is like $22 billion. Stable coins is bigger. It's $120 billion, something like this. But eventually, the liquidity staking may grow a lot, especially if we're coming to a new cycle, new mode. So one thing that I'm not sure if I understood it right, is that are you going to create an index for something the same way for stable coins or no?
Yeah, so the first instrument will be launched on the Lido staking rate. We looked at index for this, but we don't feel that there's enough historical basically history. The other thing is that different protocols have varying levels of centralization and how they publish their rates. Right. And because we're very focused on what's DeFi native, what can be done on chain, we're really going with the most liquid instrument to start and then looking at the staking index, essentially. There are a couple of different parties that are looking at kind of an index approach. One of them is Chainlink. And then CoinFund, along with the CoinDesk Indices, has looked at one and has announced one called the CESR, which I think is Composite Ethereum Stake Rate. So yeah, but I mean, still, like, the IPOR index is at our core. It makes sense to have a stake rate index in the future, but I'm just not sure that that's the most useful thing now. We really rely on a lot of historical data when we're looking at, what are the different models that we build in-house, not only for the index, but for the automated market makers. And so, yeah, I think there probably will be one down the road. But we will go to market with a Lido rate. Okay,
and so the Lido rate is going to be the to swap between fixed and variable. And so, are there any plans in the future to add others like a rocket pool or maybe a swap between those interest rate? I don't know if it would be easy to make.
Yeah, I think so. I think so. The big question is, how much do they, converge or diverge? And my guess on it, on an intraday basis, a lot, but over the long run, not as much. So I mean, this requires something that's much more short term, much more speculative instrument to be able to actually, play the basis between, let's say, rocket pool and Lido.
Yeah. All right. And when you interact with this, when the IPOR interacts with Aave and Compound and or Lido, I mean, DeFi is permissionless, so you don't need to ask permission for them. But is there any formal partnership between IPOR and these protocols, or even Chainlink? You're mentioning Chainlink at some point.
Yeah, I mean, there doesn't really need to be, right? So we talk a lot with these different protocols, mostly on the integration side. You may have seen, for example, during ETC, we announced, an integration with Flux token. So Flux token is the permissionless token, interest-bearing token of the Ondo ecosystem. So Ondo is tokenizing T-bills, and Flux gives you permissionless access. So that's, for example, one of the integrations that we have planned for the V2. But yeah, I mean, we're in talks with most of these protocols. You will see some actually in some of the upcoming blog posts. And so, maybe I can drop a hint right here that Morpho, we plan to do a lot with Morpho. Morpho has come onto the scene. They really have found a very nice product market fit riding on top of Aave and Compound and improving their rate dynamics. And actually, those rate dynamics match very well with the IPOR index. So, Morpho has a P2P cursor, which matches borrowers and lenders between, the lending and the borrowing rates on top of Aave or Compound, but that's effectively a mid-market rate, which is also what the IPOR index is. So it actually creates a very nice, hedge. So actually, one of the big focuses for the V2 is taking the end user's focus away from the index, taking away from the derivatives, and actually giving them what they really want to see, which is basically, most people just want to either park their stables somewhere and earn the best yields on the market, or they want to take, credit. So with our integration with Morpho and using IPOR capital efficient swaps, what do you get access to? You get access to the deepest liquidity pools. You get access to actually the best rates on the market. And then when you pair that with an IPOR swap, you get the best fixed rates on the market. So you're talking about very liquid instruments at the best fixed rates. And this is why we're focusing on this composability aspect, because it's very difficult to kind of replicate this. And we're not trying to. We're actually looking for integrations with some of the top players.
Oh, yeah. It was nice that I heard you say the Ondo Finance. It's the TEM MUITO protocol. I looked at this protocol, but when I tried to interact with them, it was necessary some know your customer, something I think US only. And is there any change about this right now? Is it permissionless, or how can you use this protocol if they require this kind of know your customers?
Yeah, so most of the real world asset protocols or most of the tokenizing T-bills or money market funds, they are permissioned. And so they're going to have this onboarding, and think of this as like the primary issuance, right? So most of them will have the KYC and the onboarding for the end user to get access to this tokenized, treasuries yield. With Ondo and Flux, Flux is a permissionless token, which actually represents the underlying yield. So I believe that will be launched on DEXs. We think probably on Curve, where you can trade between the underlying yield on the Flux token. So this is why we focus on the Flux token, because it's a permissionless protocol-to-protocol integration, where the IPOR protocol can actually be a market participant with the Flux token. Because the IPOR protocol, it has no physical jurisdiction, no corporation. It's a DAO, so it doesn't have the ability to go through kind of this onboarding approach. Whereas the smart contracts can become a counterpart to the F tokens, the Flux tokens.
Yeah. Oh, now I got it. So it's very interesting. So that there is Ondo Finance, the real world assets, the permission, and there is a Flux token that is kind of a permissionless part. How can you interact with that? And this starts to becoming very interesting, especially if you start to add other things like issuing bonds. The swap market there is huge in the world. There's almost $500 billion. If there is some way to have a token so people could be exposed directly to through DeFi, that would be great. Yeah, it makes a lot of sense.
Yeah, I mean, I was talking with a DeFi builder, and they were looking at doing something like a Nexo for Latin America, and we're discussing like where does the yield come from, like what kind of rates are people looking at, and he was like, you know what? It doesn't matter, what the yield is. Actually, dollarization is the alpha. It's not being exposed to volatile depreciating local currencies. And so something like that, and then actually being able to access, let's say, the Flux token permissionlessly can be quite interesting.
Yeah. And if you think about this, today we're only talking about the US dollar, then maybe Euro should be next. But even in Brazil, the Brazilian national currency in the real. Today, there is the interest rate in Brazil is 13%, and our inflation rate is about 3%. So Brazil today has the largest real interest rate in the world. So that would be very interesting to see if people from all over the world could easily interact with that. Because in Brazil, it's very difficult for us. Basically, we can only have access to Brazilian market. If I want to have access to the US, I need to have a bank account in the US and a lot of stuff. So it's very, very complicated. This is one of the big things that DeFi can do for all the people around the world, to have access to these financial instruments. So, and still talking about the IPOR and the AMM swaps for the current and the V2. Are there any plans to have larger periods of time? Because today is 30 days. So are there any news regarding this?
Yeah, actually. So, you know, the V2, you know, it was a bit, we have a lot of things that we knew. So think of the V1 as very much a proof of concept, right? We get it online, printing the index. Index has been printing now for almost 11 months. Mm-hmm. I think on average of like, you know, 5 times per asset per day. You know, the swaps have traded over 4 billion notional since inception. And I mean, that's really a testament to the capital efficiency of the swaps, right? We're talking with now around 18 million in TVL, you know, 4 billion in swaps is quite good capital efficiency, you know, not only for the traders, but for the LPs. So with the V2, we're really looking at making, you know, much more interesting, much more useful. So if we take those kind of two things, like, you know, the deposit and the credit markets, and looking at combining it with something like Morpho, we're talking about extending the duration of the swaps, which also gives you the, you know, the durations of these kind of fixed rate markets from 1 month to 3 months, so 1, 2, and 3 months, and beyond. Right. The reason that we're stopping at 3 months is we will do an assessment to understand how the models are working, how they're pricing. Maybe they can be priced, you know, more aggressively, and that will actually reduce the cost for the consumer, and then start extending that basically out, you know, 6 months, 12 months, and so this is all in process. So let me give a kind of a quick overview of the V2 from a technical perspective. So yep. One is a revamp of the architecture. So the revamp of the architecture, if you've gone through the liquidity mining process, you understand that there's a whole bunch of steps that you have to do with different, you know, contract approvals, you know, provide liquidity, stake liquidity, stake IPOR, delegate IPOR. You know, it's a lot of steps. So we took actually what's state of the art right now, which is called the Diamond Proxy. And what that means is that you interact with this one proxy contract and it routes it through the entire protocol. So that means you kind of have one point of interaction, which allows for things like, you know, easy zap-in. So let's say you come with Shiba Inu, right? And you really want to become an IPOR provider. So we have an integration with another protocol. We haven't announced it yet, but that will allow you to sell. Let's say the Shiba goes, you know, like 90% into USDT and 10% into IPOR. Okay, so this multi-call will allow you to sell, stake, and delegate in a single transaction. So that means you'll be able to basically select your APR. So you say right now, I see that, you know, if you have 5% of power IPOR compared to your liquidity, you're getting about 13%. Okay, let's say I want 20%. So I'll slide my slider up to 20%. I will click Zap In, and that will give me the right amount of liquidity, the right amount of IPOR, and the delegation to get that specific APR. So it'll make for a much simpler user experience, right? So that's one thing on the architecture. The architecture also allows us to be extremely composable with other protocols. So that makes for the base of these nice structured products. The other is the upgrade of the derivative engine. So we'd already discussed about the introduction of the risk oracle. So, the upgrade of the derivative engine allows for us to have basically tenor extension. So we're moving from 28 days to 2 months and 3 months, and again, 3 months and beyond, given testing of the AMM. We also removed optionality. So rather than being able to cancel at any time with no penalty, you can close your swap by taking an offsetting swap. But you'll still have the flexibility to take the swap at any time that you want. So instead of having these rigid term structures, we'll keep the kind of request for quote structure, which means that if you want to start a 3-month swap, you can do it now, you can do it tomorrow, you can get it 3 days from now, you can do it 1 month from now, and you have this rolling swap structure. And so those are the main upgrades to actually the derivative instrument that allow us to extend the tenors, to price the risk, and also, that allows for these kind of much longer duration base of structured products.
Yeah. So, if in the V2 with these larger periods, there, I don't know if I get this right. You're gonna have some. If you want to close the position in the middle, it's gonna have some penalty or extra fee that you don't have now.
You would have to take the offsetting swap. So let's say you're in a pay fixed. Let's say you take it for 3 months. Let's say at day 45 you want to terminate. You'll have to take a receive fixed with the corresponding notional.
Okay.
And that's how you would close it out.
Okay, got it. And are there any plans to have any change in the liquidity mining program or tokenomics?
Yeah, so the liquidity mining program, actually, maybe we can step back just a bit. We had this really well received liquidity mining program at the beginning, but what happened was there was a lot of value extracting whales that held so much liquidity in relation that they were actually eating through a lot of the protocol incentives, and we can see that through the token bleed. We set a period of 3 months, and after that 3 months, the liquidity mining parameters were revised. 2 cool things out of that. One, it's the formation of, within the IPOR DAO, an economics work group. And the economics work group was fundamental in coming up with the new parameters. And basically, the new parameters that were proposed were, you have like, let's say, a mini curve, where you have a mini curve and then a higher curve. So you have to get up to about 5%. You have to get up to 5% of IPOR to your liquidity staked to get this kind of big bonus. And if you're under that, you actually get a penalty. So, if you provide 0 power IPOR, if you delegate 0 power IPOR, you're actually getting suboptimal rewards by 50%. Right? Whereas you can very easily get a bonus. And so once that change to the curve was updated, it actually took about 2 weeks for the market to find its bottom, its local bottom so far. And that corresponds with the 2-week cool off. So we saw a lot of the value extracting larger accounts leave. If you look on the IPOR app, you can see that there's about 70–80% of the top, of the top 50 LPs are all using the power IPOR kind of to the max. And so you see a big change in the composition of the pool, where a lot of people are more rational actors now. Now, how that will change, in upcoming is there's a couple of considerations going on in the economic work group. Well, the first one is quite easy, right? There will be an ETH pool. So ETH pool, obviously, is a new place for incentives to potentially flow to, right? Sorry, one other thing that was done by the work group is that emissions were cut by 30%. So emissions were cut, and that means, fewer tokens, and that actually extended the liquidity mining program to what's now 9 years or more. And I would expect actually probably liquidity, emissions to decrease rather than increase. So the other part of that is, that there will be tokens potentially flowing to an ETH pool to subsidize it, as we bootstrap that for the staked ETH swaps. Another thing is we're looking at really how best to incentivize liquidity provision on DEXs, give some, incentives to provide on DEXs. And so this is an internal process that's been going on inside the economic work group, working through different possibilities. And so you should see something like this coming out in the later half of this year, as well as a kind of introduction of the path to fully decentralized governance.
Okay. Well, very interesting. So many news about IPOR. So said decentralized governments right now. The liquidity mining program. So you plan to have for 9 years or more, right?
Well, I mean, if you take the steady state, I can't remember the exact number, but it was 10,800, 70% of that. So if you extrapolate that with the reserves and the liquidity mining, that would be 9 years, right? So, if you tune it up, tune it down, if you have it steady state, it would last 9 years. My feeling is that it would probably last longer because, the work group would design it so that it's, best meets the long-term needs of the protocol.
Yeah. In what caught my attention, well, of all our conversations that you're targeting right now for V2 liquid staking, that it's I think liquid staking is the hottest narrative right now, and it's growing a lot. I expect to grow even more the next years, and also the real world assets. So it starts to get very interesting for the coming years. And all right. So is there any other any news that we didn't talk about that you'd like to mention, Darren?
No, I think that covers most of it, right? We'll be changing a lot of our messaging to focus more on easy conceptualization of what you can do with IPOR. So, if you think of like real world assets, think of it like as a liquidity bridge between traditional fixed income and DeFi. So, there's this hundreds of trillions pent up in TradFi in fixed income, that's kind of waiting to come through the doors, right? So, we're kind of going crazy about this like treasury bill yield in DeFi, but what happens if we return dovish? What happens if we have a risk rally? If the rates in DeFi start to adjust properly, can liquidity start swinging back the other day from TradFi into DeFi? So we really look at this as like a two-way liquidity bridge. And IPOR is it runs adjacent to many other DeFi protocols. It's not really a competitor. It's more of a collaborator, right? So once you have this stability, inside of DeFi fixed income, you can have kind of liquidity rushing over this bridge, and that's really good for kind of all market participants.
Yeah, totally agree. I see IPOR like I don't know if you call second generation or third generation of DeFi. People are always changing names, but I mean, looking at the DEXs and latent protocols like Aave and Compound, like first generation, IPOR totally makes sense for the next generation of protocol that I see a lot of space to collaborate with these protocols and not compete in the future. Totally agree. So Darren, thank you very much for coming again and update us about the features from V2. What are your views about this market? Thank you very much.
Thank you. Hope to see you guys again soon.
See you. E se você quer saber como operar derivativos, swap, faça parte da Academia Cripto. Eu faço várias operações de swap, já consegui fazer várias operações aí com lucro em swap de juros lá, trocando juros fixo por juros variável. Se você quer conhecer tudo isso sob detalhe, faça parte da nossa comunidade. Se você gostou desse vídeo, aproveita e dá um like, se inscreve no canal da Escola Cripto e ativa o sininho para receber as próximas notificações. Até a próxima!